cash budget complete. We probably won't stamp it anymore, but I've actually seen ones with stamps. Then we'd make a budgeted income statement. Why do we make the budgeted income statement? Because we also prepare the income statement first, right? We can't prepare the balance sheet without the income statement, statement of retained earnings. Think back to your financial accounting course. So budgeted income statement, we know our sales. So we're going to budget our sales, our cost of goods sold, which went from we have our sales budget, we have our cost of goods sold budget, and our gross profit is $137,600. No, this has to be GAAP, right? This is GAAP information, no longer variable costing. So this cost of sales includes our fixed overhead. Then our operating expenses, but we can go back and find our sales commissions, our sales salaries, our administrative salaries. And this is for the whole quarter, right? 3 months. Make sure if you're getting confused about any of these numbers, for the full 3 months. So I'm going to jump back to the sales budget real quick, right? On slide 41. If I jump back to the sales budget, you should see it's for the full 3 months is 192,000. 192,000. So all these numbers tie. So you can follow this full example for any of your other examples. I provided these slides for you. So 192,000. I'm not pulling any individual month. I'm pulling the entire 3 months. Let's go back to our slide here. Same thing. We go to our cost of goods sold budget. All this information we're just compiling now. We have the information. We're just putting it into the income statement format. 54,400. And we have operating expenses. We just go back to our previous budgets. Interest expense we got from our cash budget. Administrative we got from our SG&A. Our general administrative budget. Sales we got from our sales budget. Right. Income, cost of goods sold we got from our cost of goods sold budget, the 17 times the 32,000 units. And then we have our income before income taxes. And then we have our income tax expense of 40%. Income tax is a little more complex than that, but for now, just know that if I ask you income tax expense, this is how you'll do it. Just apply a flat rate. 40%, and then we get our net income. So all this information we're just pulling from our previous budgets. Seems like a lot, but really just flow. And in reality, we have software now that will pull all this information and you'll just go and check it. Or at the very least, you'll have a spreadsheet pulling in all of the information. So all you have to do is check and make sure all the numbers are correct. Then we're done with our budgeted income statement. Easy peasy. Now we have to do our budgeted balance sheet. Budgeted balance sheet. A lot of footnotes here, but we'll walk through it. So cash, where do we get this cash from? Cash from the cash budget. Where's our cash budget? Cash budget, ending cash, 44,706. 44,706. Accounts receivable. That's the 60% of the remaining of the sales budget. Right. So from our sales budget, remember 60% of our final December sales. So if I go back to the sales budget, we'll get our 50,400. Our raw materials and inventory. So on the raw materials budget, that was our ending inventory of December. Finished goods, that the same. If we go to finished goods, you can see here all the footnotes were for is the budgeted finished goods inventory at the budgeted cost per unit. Equipment's the 225. This equipment is where we can see down here the $200,000 beginning balance plus we bought $25,000 of equipment. We didn't take depreciation into consideration for this budget to simplify it. It's already complex enough built into the equipment. We splitting out depreciation here in F. We have 36,000 at the beginning plus 4,500 depreciation expense in the factory overhead budget. So in our factory overhead budget, we have depreciation not for the $25,000, but for the $200,000. Well, so we made the $25,000 purchase at the end of December. And so we add that depreciation expense in to our beginning balance. And then we get our total assets will be the addition. We take the equipment less the depreciation and add all the assets together. Liabilities. At the end, we no longer have a loan. We paid off the loan, so that's gone. Our accounts payable, we get from our purchasing budget, and then we just take the percentage of that purchasing at the end of December. So that's just from our purchasing. Income tax payable, we have calculated here from the budgeted income statement. Budgeted income statement here, 39,502. We sum this up. Our total liabilities are 49,202, and our common stock didn't change. We'll just get this from our previous financial statement. Common stock didn't change at all. The retained earnings has changed. We've added income to it, and see if we have it. Where's the footnote here? I unchanged for the balance sheet. The beginning balance, plus we have the income, plus we paid $3,000 in dividends. That's how we got this retained earnings. Now we paid out the dividends. So that's it. We have our income statement, our balance sheet. I'm not going to make you do a statement of cash flows about projection of that. That can be a little more complicated. I'm not going to make you do an equity roll forward. The balance sheet is complex as it is, and there's just going to be a homework assignment on it. So you have your time. And the reason I'm giving this homework assignment to you, and I really would think it's helpful, is just to go see how all of these numbers flow through. And you can check your answers and just practice flowing through all of these numbers. But don't remember that your quiz, your midterm and final are going to be multiple choice. I'm not going to ask you to put together a complex budget like this. This is just for you to see the full picture. Budgeting for service companies. Service providers also use master budgets, right? Service companies, I love service companies because they're much more simple in a lot of regards. There's other complexities like hiring talented people. That's the challenging part of a service company, and proving your talent to the world, to your and making sure you beat out your competition. But from a budgeting perspective, you just have your staff and you have your sales. So you have just your direct labor. We don't have any of the manufacturing budget components. So service companies, just like running a CPA firm, running a consulting company, are a lot easier to manage from a financial perspective. The only problem is they're more difficult to scale because you can't just make product and have a few people working on those products. So that's the idea here. We don't have to worry about overhead. We don't have to worry about you could do some overhead application, but we don't have to worry about it for this class. And then you don't have to worry about direct materials, which makes things a lot more simple. No production budget. In reality, you need some kind of forecasting to figure out how you're going to staff jobs, but from a budget perspective, it's not too bad. That would be in your direct labor budget.